Hello, in this video I want to talk to you just a little bit about some of the short-term funding or financing considerations for firms. This mostly has to do with short-term capital needs related to current accounts and the use of short-term debt. So let's hit these from a learning objective standpoint. The first thing is that I would like to be able, in addition to the long-term financing options available to the firm, they do have a number of options available if they have short-term capital needs. And so what I want you to do is to be able to identify four possible short-term funding options, describe how each could be used to free up cash or create cash, and then talk about the potential negative consequences to the firm of pursuing those. And so this is sort of a good news, bad news discussion in terms of good news, you could get cash from those. Bad news, the consequence of that may be more than just that have to pay the cost of the funding or something like that. So generally speaking, the four current accounts that we would focus on the most, you notice we don't have cash in there because cash is the account we're trying to get stuff into. The four current accounts we would focus on would be inventory or work in process, sometimes called WIP. Work in process, if you're not familiar with that, is a term for, particularly for manufacturing companies where something isn't finished and ready to sell yet, but it is in the process of being produced. And so you do have money tied up in the materials and the labors getting ready for that. And so you could have some money tied up by the amount of products that you have in process. The accounts receivable account, the accounts payable account, and then, of course, short-term debt, which would be your current liability account. So let's talk about with those accounts what you could do. Well, let's see. If you have a whole bunch of money tied up in inventory, you could reduce either the amount of goods you're producing if you're making your own product, or let's say you're a retailer, you could reduce the amount that you're purchasing wholesale so that you have less inventory. By reducing the amount you're purchasing, keep in mind that as you sell stuff, you have revenue coming in, and you don't have as much revenue or money going out because you're not buying as much to replace those sales as you make them. And so that could certainly increase the amount of cash that is available for the business. The consequence, though, is that if you start reducing the inventory, then you run the possibility that when a customer walks in and wants to buy something, maybe you don't have the thing that they want, or you don't have enough of it. They want 10 of them and you only have 5 or whatever it is. And so they may just buy the 5, or they may walk out and go someplace where they can buy all 10. And so you potentially miss sales opportunities, and therefore your revenue goes down. So in the short term, this solution might generate some cash in terms of saving the amount that you're paying out to suppliers for materials or in production, paying labor and so forth in production. But in the long term, it has the potential to actually reduce the amount of money that you have coming in from sales. And so this can only be a short-term fix. Also understand that when you reduce inventory, let's say that you currently have $20 million tied up in inventory, and you decide that you're going to reduce that to 15 million by, just not ordering as much, let's say. So there's a greater chance of you losing that. You don't get an extra $5 million, say, every month from that. You get a one-time $5 million, growth in your cash account from that. And so you can't count on that to just keep going on. So it's the one-time $5 million versus what are you going to lose in terms of sales. In terms of accounts receivable, you could reduce the number of days on credit terms. So you could imagine that if I'm offering 60-day credit terms and I reduce that to 30-day credit terms, then over time what's going to happen is the people who borrowed on 60-day terms will start making their payments, and at the same time, those that borrowed on 30-day terms will make their payments, right? And so, a month from now, the 30-day people are going to pay, and the 60-day people from 2 months ago are going to pay. 2 months from now, the 30-day people are going to pay, and your last batch of 60-day people are going to pay. And so, during those two periods, your cash account's going to grow. Once you get past that period, no more new cash coming in. All right. And you can, basically, you can think in terms of sort of a ratio. If I have, let's say, $20 million tied up in accounts receivable, and I cut the number of days in half, then I would expect over time that accounts receivable balance will drop by half, or $10 million, and that'll just be $10 million more in my cash account. Now, the bad news about that is that accounts receivable is one of the things that some companies use to gain a competitive advantage over other companies and encourage customers to come buy from them. And so if, one of two things, either maybe you have very favorable credit terms in terms of number of days to pay versus others, and that's one of the reasons people come buy from you. And if you cut them back, then fewer of them are going to want to buy from you. Or potentially the even worse case where everybody in your industry has, say, 60-day credit terms, and you're the first one to cut back to 30. Well, suddenly you're not only just drifting back to where everybody else is, you are now at a competitive disadvantage to them. And so you may lose a lot of customer sales depending on what else you have going on. And so again, that's going to reduce your revenue in the future because you're losing those sales, and that's going to start eating into your cash accounts in the long term. Accounts payable, that's how timely you pay your suppliers. And so again, even if you're a manufacturing company, you have to buy materials and so forth from people. Usually accounts payable doesn't include things like labor costs, because you got to pay those people when you got to pay them. And if you're a retailer and you're buying wholesale, then obviously you're paying off your suppliers as well. And so again, if you were to increase the number of days that you pay your suppliers, then think about it this way: you get some stuff from them today, and you normally pay them in 30 days, and then you just decide, well, I'm not going to pay them in 30 days. I'm going to wait and pay them in 60 days. So ordinarily 30 days from now, you'd have a bunch of money go out. You don't have that happen. It doesn't go out until 60 days. And then after that, the same amount kind of goes out every time. And so you get that one-time kind of increase in your accounts payable. Now, the consequence of that is extending the amount of time that you pay your suppliers usually is not something that you go to them and they just say, oh yeah, that'll be fine, pay me later. Usually it's a decision that you make because you're having a tough time making payments. And so the suppliers are going to become a little antsy with you, and they may get to where they don't deliver things timely, or they don't deliver as many of them, or they might miss some deliveries. In other words, you're no longer their preferred client because you're not paying timely. And so that's going to disrupt the supplies that you have, which then will disrupt the amount of inventory you have, which means kind of the same thing as cutting back on inventory. It's going to eventually reduce your sales and your revenues. One other thing that's in there, it may increase direct labor costs. And so think about somebody that staffs up their folks to be able to make a certain amount of goods if they're producing, or from a retail standpoint, they've got people that they pay that are ready to accept and process the deliveries, and then those deliveries from the suppliers don't show up. Well, you still have to pay those people even though you don't get any production out of them. And so in terms of, if we said on a per unit basis, so let's just say what are the labor costs associated with each unit that we actually sell, that goes up because you're having to pay people even though they're not doing something, and that gets spread out across all the times that they are doing something as well. And it just makes the overall average per unit go up. The last sort of funding option, the most obvious one, I guess, for people would be to acquire short-term debt. So you just go out and borrow more current debt, and current debt is debt that is due in less than a year. Usually it's defined by the accounting year, but sometimes just defined by a calendar year. So you just go borrow more debt. Now, the big gotcha with that is, unlike long-term debt, particularly bonds that companies issue, where they don't make any principal payments right up until the maturity of the bond. Here, you have to come up with the cash within the year. And so, there is that risk that either there'll be more cash shortages or your sales will drop off because of some of these other things that you're doing, so forth. And you'll be in a position where within the next year you may be unable to make a payment on debt. Now, the consequence of that is that's not just something that affects your relationship with that one lender. Oftentimes, if the way that debt agreements are set up, if you fail to make payments or you default on payments to any one lender, that's treated as a signal of default for all lenders. That could force you into bankruptcy, could raise your borrowing costs. There's all sorts of consequences if you actually miss the payment. Well, the more current debt that you have, the more risk you've put yourself in that you might miss a payment. So, again, trade off on that. You can raise the money, but you do increase that risk. Now, if you're somebody that's, that already is in good shape in terms of your financial situation and your credit quality and everything else, raising this short-term debt may not be a big issue for you. But let's face it, if that were the case, why are you out trying to raise short-term debt? So next thing we're going to talk about has to do with what we would call current asset policies. And generally speaking, you can think of those policies as being flexible or restrictive. What we're talking about here is sort of an investment policy. How much do you want to invest in your current assets? Current assets being cash, inventory, accounts receivable usually, right? And so kind of two different points of view on that, and we want to go through that. So, let's talk about the implications in terms of what each policy means in terms of what you're going to do to specific asset balances and how that might generate some cash inflows and outflows for you. And then what that might, what types of firms you might typically see pursuing each of these policies. So, two policies: flexible policy, restrictive policy. Again, 3 current asset accounts: cash and marketable securities. A lot of times we just call that cash, but companies, if they're holding big cash balances, they'll sweep them into money market accounts or whatever else so that they earn some overnight money. It tends to be very safe, very liquid, so we kind of lump all that together. Accounts receivable, we've already talked about, in inventory. So under a flexible policy, just think of it as I'm going to invest a lot in all of these assets. So I might hold more cash and marketable securities so that I know that I always have enough cash to meet my needs. I might offer a higher number of days in credit terms so that I can get the maximum benefit in terms of customer demand. Obviously, that's going to increase the amount of investment in accounts receivable, and I'm going to need cash for that, right? In terms of inventory, I could hold more inventory to make sure that I always have plenty of supply for my customers. That way I don't miss out on any sales. But obviously that's going to increase the investment in the inventory, increase the cash that I've got tied up in that. Or I could go with a restrictive policy. And again, you could do it on individual accounts, but what we're really talking about here is a company sort of consistently doing this across all its accounts. Okay, so in the restrictive policy, they might hold less cash so that they don't have a whole bunch of idle cash sitting around that's not in productive assets. We talked many times about the fact that investors are typically not thrilled, equity investors are typically not thrilled with the concept that you've got a big bag of cash sitting someplace doing absolutely nothing. They would rather have that cash back so that they can use it to invest in things that'll give them a rate of return. And so, some companies prefer not to hold a lot of cash. You could lower the number of days on your credit terms, which of course will then reduce the amount of investment in accounts receivable, as we talked about before, or you could choose to hold less inventory, and we talked about before that could cause you to miss some sales, but it will cut down on both the amount that you have tied up in the inventory itself and the cost of having to store that inventory. If you as a company you plan to have lots of inventory, then you usually have to plan to have lots of warehouse space or showroom space or whatever that is. You got to pay more square footage to have a place to put all your inventory. And so if you make a policy decision that you're going to hold less inventory, then you can sell off some of that space and save the cost of that as well. What about the impact on cash flows? Well, obviously, if I pursue a flexible policy from a revenue standpoint, I could expect that the cash flows would be higher. I'm doing everything I can to make sure that I increase customer demand, that I incent them with AR policies. I make sure that I've always got enough cash for operations so that my suppliers are doing stuff regularly and all of that sort of stuff. And so my customers ought to be very happy, and I ought to have good revenues from that. Whereas my carrying costs are going to go up. So my revenue went up, but my carrying costs go up. And so there's kind of two sides to those carrying costs. One is what's sometimes called an opportunity cost. It's just the fact that I had the money that's tied up in these current assets came from someplace. And, if I either gave it back and so I don't have to pay the cost of capital on that, or I would put it into other investments that actually gave me a rate of return, then I'd be getting more value out of those. And so the issue here is that they appear to be amounts just sort of sitting in the middle of the floor, and I'm not getting the kind of return on those that I get on other assets, and so that has to be factored in. The other possibility, the other cash flow consideration is shortage costs. Again, shortage costs are, missed sales or transaction costs because, I run out of something and so I got to call a supplier and have them ship it rush, and, they charge extra for that. And so obviously under the flexible policy, I would be reducing those costs. And so while I may be increasing carrier costs, I'm reducing the missed sales and reducing the transaction costs. And so those may balance out to the point to where that's kind of break even, and I'm getting more revenue for it. So that's great. On the restrictive side, obviously by restricting the accounts receivable and the inventory, I'm likely going to miss some sales, and so I'm going to see my revenue go down, and that's a very clear cash flow impact. But I'm not going to have nearly as much cash tied up in these things, and so I can free that cash up maybe to either invest in productive opportunities, or I use it to buy back debt and equity and improve the return on equity for my company. But again, I'm going to have these increased shortage costs. And so kind of the revenue and the shortage costs in this sense sort of go hand in hand because of the missed sales. But there is this extra shortage cost of I may find myself more frequently having to call somebody up to get me a rush delivery on something. There's more handling costs associated with it. There may be more shipping costs. So, that's kind of the balance. And so, you have to ask yourself, well, if you have these two policies, what kinds of companies would pursue one versus the other? And I want to be clear here. When I go down this list of sort of the characteristics or factors that describe a company for each of these, it's not necessarily the case that A company has to have all of these characteristics in order to pursue the flexible policy, or all of these characteristics to pursue a restrictive policy. They may choose to do something more or less flexible simply because of one of these factors. And so, any of these could potentially shift them in one direction or another. I would say if you saw a company that possessed all of the characteristics of a flexible policy, you could pretty much expect that they're doing a flexible policy. Same thing with a restrictive. If they possess some of those characteristics, they may lean more towards one policy or the other, but maybe not be all the way to the extreme. All right. So, talk about the characteristics. First is the stage of the life cycle. When we think about companies, we think about them going through sort of a new stage, a growth stage, where they're out there trying to make their name and get themselves to become a big company. And then they finally become a big company, and they start to reap the benefits of that in terms of having easy access to capital, all those sorts of things. Their growth rate slows down, which usually means that their uncertainty about what their market share will be and their sales will be goes down, and they sort of become this sort of predictable. We sometimes call them cash cows. And so, in the companies that are in sort of the earlier the growth stages, tend to have flexible policies because that's part of their investment. Is we want to go out and capture market share, and they understand that they need the inventory and the accounts receivable in order to attract and compete for that market share. Whereas companies that are sort of at a mature level, they've sort of already locked in their market share, if you will. Oftentimes they kind of look at it and basically say, look, we've already beat out all the young up and comers and all that sort of stuff. There's just a few of us in the industry. There's not a whole lot of growth opportunities. So about the only thing we can do to return more value to our investors is focus on reducing our overall costs. And so we may reduce the investments in accounts receivable as a way of reducing that cost. Another factor you might consider is just the riskiness of the cash flows. Again, sometimes that goes hand in hand with being a growth company, but sometimes it's just industry specific. And so if you have more difficulty in accurately forecasting your cash flows, for example, then you're going to need a bigger cash buffer. If you have usually that comes because maybe you have a hard time estimating how much your actual quantities that you're going to sell are, in which case you may need to have more inventory to just be ready in case there's a sudden growth spurt. So both of those could cause you to have higher asset investments. Whereas if you've got fairly low risk, you've got pretty good certainty about how much your sales are going to be each year. You have pretty good certainty about what your cash needs are going to be. Maybe you don't have nearly as many sort of investment opportunities that pop up throughout the year, and you're just sort of focused on funding your operations. You probably need less cash reserves, and you may also need less inventory. In terms of credit quality, companies that have low credit quality, a lot of times they need to hold on to more current asset balances just to get some of those liquidity ratios that talk about, if you had to liquidate stuff to be able to make payments on debt, do you have a lot of stuff to liquidate? A lot of times they hold these higher balances just so that they can, in terms of current assets, so that they can improve those measures and try to improve their credit quality and lower their cost of debt. Whereas firms that already have high credit quality, maybe because they've just got so much in long-term assets and cash and so forth on hand, or whatever, maybe not cash, I guess, then they probably, they don't need to hold all of these things in order to convince debtors or lenders that they will make their payments. There's not that same concern, and so there's no reason for them to overinvest in current assets. And lastly, you got to consider access to capital. A lot of times this will go hand in hand with credit quality, But it's not necessarily just about credit quality. It's not, oh, you're a bad person to lend to. It may be that you're just too small, or it may be that you're just too new. And so as a result of that, you can't tap into the big money that a big company can tap into. Maybe you're too geographically limited, and so you can't find investors. You can't tap into the global financial market, as an example. So if you have poor access to capital, then you have concerns about whether or not you can easily go raise additional capital in the short term if you need to. And so you'll probably hold more cash balances. You may hold more other current asset balances with the idea that, hey, if we got in a bind, we could always liquidate some of those and be okay until we can get our financing. Whereas if you have good access to capital, you don't particularly have any reason to manage your current assets in that way, because you basically imagine somebody that if they wanted to, they could pick up a phone and secure $100 million worth of funding in an hour. That's the kind of thing where clearly if you can do that, then you don't need to have a whole bunch of money just laying around, being non-productive. All right. So last thing I want to talk about here is how you might fund those assets in terms of current liabilities. There is a financial theory that basically says that in an ideal situation that you would want to fund all of your current assets with current liabilities, fund all your long-term assets with long-term financing in terms of equity and debt. And yet we know that companies don't always do that. And so I want you to explore, what is it about the theory that makes the prediction be that companies might do this, and what it is about the real world that's different from the theory that would cause firms to act differently. So kind of comes down to just the assumptions. Usually when you're looking at a theory and it's predicting something and you're seeing behaviors that are different than that in the real world, it's because of something that's assumed in the theory. So kind of three big assumptions in the theory. One is that the term structure of interest rates is such that short-term interest rates are always lower than longer-term interest rates. And so if I'm borrowing something that I will pay back in a year, I will get a lower interest charge on that than if I'm borrowing to pay back in 10 years. And we can talk about all sorts of reasons for that. Obviously, we have already. But that theory would suggest that you want to borrow from you want to get the lowest cost borrowing you can and use as much of that as possible. And so using as much as possible would be to finance 100% of your short-term assets with it. In the real world, it's true that at any one point in time, usually the short-term borrowing rate is lower than the long-term borrowing rate. All right, but a couple of things you have to consider. One is every once in a while that gets reversed just based on what's going on in the economy. But also, when you go out and borrow, say, for 10 years at some interest rate, a lot of times firms will go get that borrowing. They'll sort of strategically try to do more of that borrowing during the part of the business cycle when interest rates are low. All right? And so they've locked in that cost of funds, say, 5 years ago. Now the economy has changed. Guess what? If I go out today and try and borrow for 1 year, it's going to cost me more in interest than it would have cost me 5 years ago to lock in that financing. Okay? And so by virtue of that, it is not always the case that when you add this time dimension, that you get the best deal by financing with current debt. And so as long as you're thinking strategically about it, you may decide to go ahead and get more long-term debt when it's cheap, knowing that it'll be cheaper than current debt during part of the cycle. The next kind of theoretical assumption has to do with the variability in current assets. First of all, the theory is based on the idea that current asset account balances move up and down over time, whether that's sort of seasonally within a year or with the business cycle. And secondly, they assume that it's somewhat predictable, and therefore you can go get the asset, the financing you need before you need to have it, and you can know when you're going to start having declines in terms of your current asset balances, and so you can choose to pay that debt off at that time and not worry about that you're going to need the money right away. So that would be a nice situation in theory, but in fact, for many businesses, they don't have that kind of predictability. They may have some seasonality, they may have some business cycle moves, but what they really have is a real challenge predicting kind of the timing of when all of that's going to happen. And so at any one point in time, you might look at that and basically say, there's a shape to kind of how account balances go up and down over time looking backwards. But if you were looking forward trying to forecast it, it may be hard to know exactly when that turn's going to be. Well, if you're thinking in terms of financing with current assets, you have to set the term for when the current asset's going to be paid off to match the timing of when the account balance is going to drop. And we just don't really always know that very well. And so as a result of that, you may only finance part of your assets, your current assets, with short-term debt, with the idea that even if some of that comes due, and we see some decline instead of the full amount that we expect, we'll be okay. The last thing again is this access to capital. Theoretically, the assumption is you can go raise that short-term debt anytime you want, and so you can do it instantaneously. So as soon as you see that you're starting to consume cash for current assets, you go out and make a phone call, and you have whatever cash you need. And as soon as you start seeing that the asset balances are dropping, you go start paying off that current debt as soon as you see that. And you don't worry about the fact that, I may have misread that and we may go back up in terms of current assets a week from now. Because after all, if that happens, I can just pick up the phone and borrow some more money, and it'll be there like that. And as we discussed before, that's just not the case necessarily in the real world. Sometimes it can take weeks or months to lock in even short-term debt, depending on your situation, or you may not be able to do it at all, in which case you probably don't want to rely too much on your ability to do that. So, what are the consequences of the real world being different from the assumptions? Well, what it generally means is that most firms rely more on long-term financing than short-term financing to fund that sort of permanent cash buffer that they think they're going to need. And so the idea would basically be, because there's all this uncertainty, we have in mind some sort of a permanent, 5, 10, 15, whatever size company you are, $1 million, that we always want to make sure that we have as a buffer for surprises. And since we're always going to need that, and the whole point of if there's a surprise is we're running out of cash, meaning we probably can't raise it from short-term debt, they fund that with long-term debt. Firms that are growing or have limited access to capital or have a lot of variability going on in terms of their inventory and accounts receivable also tend to fund more of that with long-term debt, partly because that's sort of over time becomes sort of a permanent base for them. If you think about it, my accounts receivable are 10 million today, and because we're growing, they're never going to drop below 10 million again for the next 10 years. Well, I might as well go ahead and borrow for $10 million for 10 years to fund that, right? And so I'll just layer on new debt each time until we sort of level out. Now, mature firms that do have easy access to capital and have a bit more predictability, they don't have new growth going on, they're really just sort of experiencing those ebbs and flows, may tend to fund their inventory and their accounts receivable almost entirely with short-term debt as a way to reduce their cost again and give them a little bit more flexibility. So I know this is a little bit like drinking through a fire hose. I know it's a lot, but luckily it's in a video, and you can pause it whenever you want and sort of consume it a piece at a time if you like. But hopefully you find that useful.